So picture yourself walking into a casino.
Okay.
You've got the flashing lights, the bells ringing, the heavy
The
carpets.
classic sensory overload.
Exactly.
Yeah.
And you sit down at a blackjack table, and right away, you are operating within this heavily structured environment.
Yeah.
Like the dealer tells you the minimum bet, the house sets a strict maximum bet. And crucially, when you run out of chips, the game just stops.
Yeah. A pit boss might even politely tap your shoulder and ask you to leave.
Right. The game has defined physical limits.
Mhm.
But when you log into a brokerage account and you enter the stock market,
It's completely different.
you are stepping into like the only environment in the entire world with no beginning, no end, and absolutely no limits.
Not at all.
And according to the research we're doing a deep dive into today from Mark Douglas's work on trading psychology, that total lack of boundaries isn't liberating for us. It is a total psychological nightmare.
It really is. I mean, it fundamentally breaks the human operating system. Well, think about how we are raised, right? From the moment you are born, society conditions you to function within external structures.
Oh, sure. Like your parents set your bedtime.
Exactly. School dictates your schedule with bells. Traffic lights tell you when to stop and go.
Your boss gives you a deadline.
Right. We spend decades, literally our whole lives, relying on external forces to regulate our behavior.
So we're just used to guardrails.
Yeah. So when you suddenly step into the financial markets, which is this entirely unstructured environment that honestly does not care if you exist.
Yeah, the market doesn't care about you at all.
It doesn't. It doesn't tell you when to enter, and it certainly does not tell you when to exit. And you are just hit with the massive psychological weight of total freedom.
Okay, let's unpack this because I have to play devil's advocate here right out of the gate.
Sure, go for it.
Isn't unlimited upside kind of the entire point of investing?
I mean,
Like we constantly hear about venture capitalists or, early tech investors who put in 10 grand and walk away with 10 million.
all right, the unicorn hunters.
Exactly. The American dream practically mandates that we seek out environments with no ceiling. So why is a lack of rules suddenly a hazard?
Well, what's fascinating here is that you're touching on a really common misconception,
Yeah.
which is conflating institutional portfolio math with individual human psychology.
Okay, what's the difference?
So, venture capitalists survive unlimited upside because they impose severe mathematical structure on the back end.
Oh, like they expect to lose a lot.
Exactly. They know 90% of their investments will just go to zero. So they structure their capital to absorb that.
Yeah.
But for the average retail trader,
Yeah.
stepping into an unlimited environment triggers what Douglas calls the illusion of fulfillment.
The illusion of fulfillment.
Yeah, because a stock could theoretically go up 1,000%. Your brain stops viewing the trade as a simple probability matrix.
So what does it become?
You start projecting your deepest personal desires onto those flashing numbers.
Oh, wow.
Every single trade becomes this, guaranteed lottery ticket that has the potential to pay off your mortgage, let you quit your job, or just fix your life.
So treating the market like that, it's kind of like driving a supercar on a track with no speed limits, but suddenly realizing there are no brakes or guardrails either.
That is a perfect way to put it. You're going 200 miles an hour, totally blind to the risk.
And once your brain shifts into that fantasy mode, the objective reality of the market just gets totally warped.
It's completely warped.
You aren't really managing risk anymore. You are actively protecting a daydream, which makes total sense of this concept in the sources that completely blew my mind today.
Oh, the trap of the passive loser.
Yes, the passive loser trap.
Yeah, that dynamic is one of the most dangerous mechanisms in an unstructured environment.
Because it's so easy to just do nothing.
Right. Think about it. In almost any other area of life, to lose continuously, you have to take continuous action.
Look at the casino.
Exactly. If you're losing at roulette, you have to actively reach into your pocket, pull out more cash, and place it on the table to lose again.
The physical friction of doing that acts as a speed bump for your brain.
It forces you to think, wait, do I want to keep doing this? But in the market, it's the exact opposite.
Once you execute the initial trade,
You can lose your entire net worth by doing absolutely nothing.
that is terrifying.
It is. If a trade starts moving against you, the market doesn't force you to actively confirm that you want to keep losing.
You just sit there.
You just sit there. You freeze. You become a passive loser.
Hmm.
And this is where the neuroscience actually gets really fascinating.
Oh, well, let's hear it.
When you watch a stock plummet, your brain's amygdala, which is the fear center,
Right, the lizard brain.
yeah, it processes that financial loss exactly the same way it would process a physical predator in the wild.
No way, like a tiger jumping out at you.
Literally the exact same chemical response. It triggers fight, flight, or freeze. And for most traders facing a completely unstructured financial threat,
They freeze.
they completely freeze. Their logical prefrontal cortex basically shuts down, and they enter a state of total paralysis.
You know, this reminds me of deep sea diving.
Oh, how so?
Well, if you think about the ocean, it's the ultimate unstructured physical environment.
Right, yeah.
It's pitch black, it's vast, there's no up or down, no gravity really.
Yeah.
Divers have to rely on a depth gauge to tell them where they are.
Right.
Because without that gauge, if a diver goes too deep, they get hit with nitrogen narcosis. They literally get intoxicated by the environment.
Oh, wow,
They
yeah.
feel warm, they feel euphoric, and they might actually swim further down into the abyss thinking they're swimming up to the surface.
That is a phenomenal mechanistic comparison.
Their brain just creates a pleasant illusion while they are actively dying.
And in trading psychology, that nitrogen narcosis is called selective perception.
Selective perception.
Yeah. When you are paralyzed in a losing trade, cognitive dissonance kicks in. Your brain just cannot handle the psychological friction of holding two conflicting realities.
What's reality?
The reality of, I am a smart person who needs this money, and I just made a decision that is actively destroying my wealth.
Oh, that's heavy.
To resolve that friction, to soothe the amygdala, the brain literally alters your perception of
He
reality.
filters the data.
It actively blocks threatening information from fully registering in your conscious mind.
Wait, really? Like, you don't even see the bad news?
You will sit at your screens watching a stock tank, and you will aggressively scour the internet for, like, the one obscure forum post or minor news headline that supports a reversal.
Oh man, the confirmation bias is real.
It's intense. You will stare at the chart and only see the green ticks, the momentary fractions of a cent where the price bumps up.
And you just completely subconsciously filter out the overwhelming red avalanche that is wiping out your account.
Exactly. Your brain is burning massive amounts of glucose to maintain the fantasy, because acknowledging the reality would trigger a total psychological collapse.
It's incredible. The human brain is working overtime to protect the feeling of being rich, completely at the expense of protecting the trader's actual real-world bank account.
It sounds crazy, but it happens every day.
So if the brain is operating like a diver with narcosis, swimming deeper into the abyss because it feels warm and fuzzy,
Yeah.
at what point does this delusion finally break? Like, how does the trader ever actually exit the position?
Well, it isn't a logical breakthrough, I can tell you that.
So they don't just figure it out.
No, the trader doesn't suddenly snap out of it, run a moving average calculation, and say, my thesis was incorrect.
Right, that would be too easy.
The delusion only shatters when the magnitude of the financial loss becomes so overwhelmingly massive that the physical and emotional agony of staying in the trade.
Finally exceeds the pain of admitting failure.
Exactly.
Here's where it gets really interesting to me. It's the Wile E. Coyote moment.
Yes, the cartoon.
He runs straight off the cliff, his legs are spinning on thin air, and he is totally fine as long as he stays in denial. Gravity doesn't even pull him down.
Yep, he just hangs there.
The forced awareness only hits the exact second he stops, looks down, and his brain has no choice but to process the fact that there is no ground beneath him.
Right. And in the market, looking down is usually the moment your broker issues a margin call, or your account balance hits a number so low, it just triggers a raw survival panic.
Right.
You are crushed into awareness.
But why is the brain so allergic to taking a small, like $50 loss early on? What is the psychology behind avoiding that initial pain so desperately that we are willing to let the account drain to zero?
To understand that, we have to look at how we tie market performance to our subconscious self-valuation.
Okay, self-valuation.
Yeah, and Mark Douglas illustrates this beautifully in the sources with a rather visceral metaphor.
Right.
He calls it the urinal penny story.
Oh, I highlighted this in my notes. Walk us through how this works.
Okay, so imagine you walk into a public restroom and you see a shiny penny sitting at the bottom of a urinal. Will you reach in and pick it up?
Oh, absolutely not. No way.
Of course not. Why? Because your internal self-valuation, your subconscious sense of worth,
Yeah.
dictates that your dignity and hygiene are worth far more than 1 cent.
Right. The math doesn't add up.
The reward does not match what you believe you deserve, so you leave the money on the table. But what if it's a crisp $100 bill sitting in that same urinal?
Honestly, I'm probably finding a paper towel and reaching in.
Exactly.
Yeah.
Most people would, because suddenly the external reward crosses the threshold of their internal self-valuation.
Ah, okay.
They were willing to endure the discomfort because they believe the $100 is actually worth the psychological cost.
That makes total sense.
Now, apply this to the completely unstructured environment of the stock market. Every day, the market offers you opportunities to take profits or cut losses. But if your internal self-valuation is low, if you subconsciously harbor feelings of guilt, inadequacy, or a belief that you don't actually deserve to be wealthy,
You will find ways to leave the money in the urinal.
yes, you'll
Yeah.
self-sabotage.
Wow.
When you're sitting in a losing trade, cutting that loss early requires you to assert your own worth.
It requires you to say, my capital and my mental peace are too valuable to be drained by this bad position.
Exactly. But if you lack that deeply rooted self-valuation, you just freeze. You become the passive loser.
You just accept the financial degradation because subconsciously it aligns with how you value yourself.
It does. It matches your internal narrative.
That is heavy. It means our trading accounts are basically a direct financial reflection of our self-esteem.
They absolutely are.
And I imagine the psychological trap becomes infinitely more dangerous when you introduce the concept of scared money.
Oh, if we connect this to the bigger picture, scared money acts as an absolute accelerant.
Remind me, what exactly counts as scared money?
Scared money is capital you absolutely cannot afford to lose. Money earmarked for rent, a mortgage, or groceries.
The survival funds.
Right. When you bring survival money into an unstructured environment, you completely destroy your objective baseline.
Because you aren't just hoping for a win to buy a nicer car, your actual biological need for shelter and safety is on the line.
Yes, and that spikes your cortisol levels completely off the charts.
I can imagine.
The pressure to fulfill the fantasy completely overrides your sensory input. If you admit the trade is failing, you aren't just admitting a tactical error.
You are admitting you can't feed your family.
Exactly. And the brain simply will not allow you to process that level of trauma voluntarily.
So the Wile E. Coyote denial phase locks down like a steel vault.
Yes, and selective perception works overtime until the account is completely obliterated.
Okay, so if human psychology naturally defaults to denial and the brain actively sabotages us in unstructured environments, how does anyone survive?
It's tough.
I mean, we clearly aren't wired for this. If the market won't act as the casino pit boss, we have to build the physical walls ourselves.
We do. And this requires a fundamental shift in behavior. You cannot rely on your in-the-moment discipline.
Because the amygdala has already taken over.
Right. As we've discussed, when the amygdala fires, your discipline evaporates. You have to predefine your limits before the trade even begins.
Before the adrenaline hits.
Before the fantasy takes root, yes.
Which brings us to the psychology of the stop loss.
Very important tool.
Now, we all know what a stop loss is technically, right? An automated order to sell if the price drops to a specific point.
Yeah, that's the mechanical definition.
But functionally, based on what we're discussing today, it's not just a risk management tool. It's an outsourced boundary.
It is the depth gauge for the deep-sea diver. It's the artificial brake on the car.
I like that.
A stop loss forces you to do the one thing human beings absolutely despise doing, which is pre-admitting you might be wrong.
That is so hard to do.
It is. When you set a hard stop loss, you are formally defining the exact parameter of your failure before you even enter the arena.
You are saying, if the price hits X, my thesis is invalid, and I accept the pain of the specific limited loss.
Precisely. But here is where the passive loser mentality creeps back in.
How so?
The sources point out that the most fatal mistake people make isn't forgetting to set a stop loss.
Wait, really? What is it then?
It's that as the stock price plummets closer and closer to that red line,
Oh, no.
they log into their account and they move it.
They dragged the line further down.
They drag it down, which completely defeats the psychological purpose of the tool.
Why did they do that?
Because the nitrogen narcosis is setting in, they tell themselves, the market is just having a weird day. I just need to give the trade a little more room to breathe.
Wow. But that is not strategy.
No, that is the hope spiral. That is your brain desperately trying to delay the pain of unfulfilled expectations.
They are extending the cliff for Wile E. Coyote just a few more feet.
They are trading an objective, predetermined boundary for a completely fabricated fantasy. And every time you move that stop loss, you reinforce the neural pathway of the passive loser.
You basically teach your brain that limits aren't real.
Exactly. And that hoping is a valid substitute for acting.
So what does this all mean? Like, how do we break the loot? How do we stay grounded when the numbers are flashing red and our self-valuation is getting tested?
Well, the sources provide a really elegant reality check exercise.
Let's hear it.
It's a single question you are supposed to ask yourself whenever you feel that paralysis creeping in.
Okay.
You have to stop, detach, and ask,
Yeah.
am I seeing what is happening, or am I seeing what I hope will happen?
That is so simple, but so powerful.
That simple question is the ultimate antidote to selective perception. It forces the prefrontal cortex back online.
It grounds you.
It demands that you distinguish between the actual, observable forces at play in the market, the literal bids and asks, and your personal emotional baggage.
Because to survive an unlimited environment, your risk must be evaluated based purely on the consistent behavior of the market participants.
Right.
It can never be based on your personal need for the money or you need to be right.
The market does not know you. It does not care about your rent, it doesn't care about your self-worth, and it certainly doesn't care about your dreams.
Cold, hard reality.
To operate objectively, you have to trade without fear. And you can only achieve a state of fearlessness if you have absolute, unbreakable trust in the limits you have set for yourself.
Which brings us perfectly full circle. To wrap up this deep dive for you, the listener, the core takeaway from Mark Douglas's framework is this. Total freedom without structure isn't a gift.
It's a trap.
It's a total trap. The stock market is an entirely unlimited environment that demands self-imposed limits.
Absolutely.
Fantasies of the big win aren't just harmless daydreams. They are the active psychological mechanism that causes catastrophic financial loss.
Yeah, it's the lack of boundaries that destroys us.
Because it allows our brains to freeze, turning us into passive losers who just watch the ship sink rather than admitting we steered it wrong.
And, this raises an important question.
What's that?
It forces a fairly uncomfortable self-audit. If our brains are this vulnerable, if we automatically filter out reality and endure massive damage just to protect a comforting fantasy in the financial markets, we have to look at our daily routines.
Oh, that's a great point. Because the market isn't the only unstructured environment we navigate.
Not at all.
Think about the infinite, bottomless scroll of social media.
Oh, perfect example.
There is no stopping queue. There's no pit boss telling you to go to bed.
Right. Or consider an undefined career ambition where success has no actual finish line and you just keep sacrificing your weekends for a vague promotion.
Man, Where else in your life are you operating without a depth gauge? Where might you be stuck in a psychological hope spiral, selectively ignoring the actual cost to your time, your relationships, or your well-being, just to keep a fantasy alive?
The market is just a mirror reflecting our inability to self-regulate.
A very expensive mirror if you aren't careful.
Highly expensive.
Well, thank you for joining us on this deep dive today. Take some time this week to build your own boundaries, establish your own limits where the world refuses to give you any, and most importantly, stay relentlessly curious. Remember, you might not be able to control the casino, but you can always control your chips.